G'day viewers, Michael Kalinovski here with Peter Ristevski from Mac Partners. We're here to shed some light on that all-important topic of tax. Peter's a local authority on property tax, and he's to share with us some of his views and some strategies on minimising and improving your tax situation. Peter, welcome to the show.
Thank you very much, Michael. Always a pleasure.
Thank you, mate. I think we might start off with the all-important one, land tax. Nobody likes paying it. Obviously, a lot of investors get upset about paying it. So, what can you share with the viewers on how we can maybe minimise land tax?
Yeah, land tax is a very terrible tax. In fact, it's turned a lot of people off investing in property and towards the share market.
Sure.
I see no point in it, but a lot of people don't know it's actually a state tax. It's not a federal tax. So it goes to the New South Wales government or various other state governments,
Yep.
and it's different in every state. New South Wales one, there's a threshold of I think it's $370,000, and then you pay 1.7% on the land value, not actually on the house value.
Okay.
The key is to structure your affairs effectively, to minimise that, and even in some instances you can avoid it, not forever, but to a point where you get to that critical scale. In particular, most people don't think about this when they buy a property. Yep, let's go out and buy a property, investment property,
Sure.
Husband and wife name, terrible move.
Okay.
Reason being, you've just chewed up the threshold, two people, rather than just putting it in one name, and then the third property, if you have a principal place of residence, putting it in the other person's name, you've got the threshold twice.
Okay.
By going into your first rental property with a husband and wife name, you just chewed up the threshold and costed yourself some valuable money there.
Okay. Can you just shed some light with the viewers? The land tax is governed by the local council?
No, land tax, state government.
State government. So when you get your council rates, will there be anything?
On the council rates, it gives you your land value by the Valuer General, which the state government uses to levy your land tax. So if you're wanting to know if you do need to pay land tax on that investment property, just have a look at your council rates.
Yep.
Probably one of the critical things about land tax is it's voluntary. You need to register yourself. I've seen situations where people have had 3 or 4 rental properties. They sold them in one hit. They've held them off for 10 years. They didn't realise they had to pay land tax or register for land tax.
Yep.
Then when you go to sell the property, they want a land tax clearance.
Sure.
Can you imagine the land tax liability over 10 years and 4 properties, plus penalties, plus interest? It's a terrible situation you find yourself in, but it's very important to register yourself for land tax initially to avoid these situations, because they will ask for a land tax clearance when you sell that property.
It's important on the front page of the contract, I think, on the sale as well, that there's a box there to tick.
Exactly.
Yeah, okay.
That's right.
Also, with the tax side of things for investment properties, the 221D, can you shed some light on how that benefits investors as well?
221D is probably a critical component as well of making a deal work, with negative gearing in particular and depreciation benefits that go with some properties. You can find yourself with quite a healthy tax refund. I've seen some that are 10, 15,000. A lot of people, it's great to get it as a lump sum, but if you can get it on a per pay basis, so if you're on a weekly pay packet, that's an extra $300 in your pocket, $300 a week, which will help you service the debt. Which means that you don't have to skim your lifestyle, as they say. It's then wait for the big tax time to collect your money. I think it's a great move. It's important to be able to use the cash flow on a weekly basis or fortnightly basis, rather than wait at the end of the year. It's something you need to apply for every year, so it's not automatic. Every year you need to make an application for that.
I think also, as an investor, you have to be disciplined if you do encourage to go down that road, because that extra money in your pay packet, a lot of people say, yeah, we're going to go spend it ourselves, but the logical thing to do would just to put it onto your loan. Would you be able to?
Look, I'd recommend you tell your payroll in particular, look, that 300 that you're taxing me less, can you automatically put it into this loan account, and my pay just put it into this? So you may need to get some cooperation from your payroll, but it is very important that you actually use it for that benefit, rather than that holiday, or because you can easily spend $300 a week. It can be gone very quickly, but if you discipline, like you said, and it goes straight into your loan account, you're actually reducing interest that you pay because interest is calculated on a daily basis, and that's one of the reasons that we need to be using this.
And also, like the banks, they like to charge on a monthly and get your money at the end of the month. But if you organise yourself on a weekly basis, you do cut back on your interest rate payments as well.
Yes, that's right. The more transactions that go through your loan, the interest will be charged at a much lower rate, and you do actually start paying off the principal more so than the interest. And then you can see your balance coming down, which gives you motivation and building equity into property and furthering your wealth creation by maybe going into a second property and whatnot. But these little strategies are very important that people need to put into place to grow their equity in their property.
Of course. And for the first time investor, what would be asset protection? I think is also a key part of your wealth creation. How would you sort of give a suggestion to the viewers? What's the best tip on getting yourself covered as far as asset protection goes?
One of the key things in wealth creation, I say it to everyone, is protecting your assets. There's no point creating wealth if you're exposed. Owning assets in your own name works to a particular point, which we talked about in terms of land tax, but there will come a point where you will need to structure your affairs to protect your assets.
Sure.
Even if you do buy it in your personal name, we can actually structure it where the equity that you own in the property will protect that. Because most people will target you if they know that you've got assets. You may get frivolous law claims against you because it becomes a nuisance, especially if you're in small business. You don't have time to deal with it. A lot of people will just offer a payout just for it to go away, even though there's no principle to the law case. So it is very important that you actually protect yourself in these instances, especially in small business. And if you're in particular risky businesses like the building industry or medical or anything in particular these days, it's very important that you do structure your affairs accordingly.
Excellent. And I think the biggest topic as far as real estate goes is positively geared property versus negatively geared property. Can you shed some light on the pros and cons of both strategies?
Well, Michael, I've seen a massive change in this since the GFC. Leveraging or debt has become a very bad area. I saw a statistic the other day that if we take all the debt that each household owes, it's 100% of Australia's GDP, which is a lot. It's one of the highest in the world. So at the moment, people don't want to be taking on more debt and having to service that debt. If you can buy a property where you can actually use the rental income to more than enough cover your loan repayments, that is the key. I'm seeing a lot of clients buying in areas in the southwest of Campbelltown. I saw a client buy a property for $220,000 a house. Fantastic. His rental return was $350 a week. He's going to put a granny flat on there, so he'll get another $200 a week. So on that investment of $300,000, he's going to be making $550 rent per week. Fantastic.
That more than covers the repayments, doesn't it?
Exactly, more than covers the repayments. We'll get a quantity surveyor's report as well to get some depreciation benefit. People aren't worried that much about paying tax or getting a massive tax benefit. They're more worried about, do I have to dip into my pocket to service this loan? And that's the key. Over the next 10 years, you will make money on property. Effectively, in those lower areas where it's so cheap, you're going to get a greater return from the capital base than you would say in areas such as Vaucluse. That will go up, but percentage-wise, it would be much higher in the southwest Penrith areas where I'm seeing a lot of activity.
It's more of a stepping stone out that way, isn't it? Just to get into the investment marketplace as well.
It's a great way to enter the property market. Sydney will be a fantastic market in the long term. If you hold for 10 years, you will guarantee to make money, especially in those areas.
I think now with the new technology and whatnot, we traditionally saw property double in value every 7 years. We're not seeing that anymore. I think it's more on a maybe 10 to 12 year basis. Would you agree?
I'd say so. I mean, even more so. We've never seen property come down in price.
No.
Real estate at the moment is an area where it's so difficult to come about, where every 7 years you wouldn't be able to service a loan.
No.
So it's important that we actually get in and think a long-term perspective.
Excellent. And also there's we spoke about this in private. Maybe you want to shed some light. that you've come across a way that you can actually, maybe you can help me with this, with the tax deductions
yes. We've actually got a private ruling where if you were to buy a second property and you were to live in that property, but the house that you're currently living in is paid off, so you need to borrow against that property to purchase a second property,
Yep.
and that first property that you owned is going to be an investment property. How do we claim the interest,
Sure.
even though we've used the money for the principal place of residence,
Okay.
and we're going to rent out this one? We can actually do that. We've
Excellent.
got a private ruling from the ATO. We can actually claim the interest on this. It's too much detail to go into at
Sure.
the moment,
Yeah.
but it's proprietary information in the sense that not everyone can do it. We've actually got a specific ruling from the ATO, and happy to talk to people about this. This is a very important area that it shows that, you know, if you think outside the square and you're aggressive and proactive in the things that you do, you will find a way around it.
I agree. And paying tax is not literally a bad thing, it's minimising your tax, which is a smart way of doing things, isn't it?
Exactly. Using the tax system to create wealth is the key. There's no point paying more than you have to. It's the key is structuring.
Yeah.
It comes down to structuring and nothing more.
Pete, it's been a privilege talking to you. Can you just tell us how we can get in touch with you?
Definitely. My phone number is 9299 7000, or my mobile 24/7 0488 927 927. Either way, give me a call. Happy to discuss these aspects that we've spoken about with Michael.
Excellent.
There's a lot of things out there that you can do that not many people are aware that you can do.
And obviously I'll have all the information below us as well, so you can get in touch via email and through their web pages. And if there's any other questions, shoot us out an email, and I'm sure that Peter will be more than happy to help out. Pete, thanks again for sharing.
Thank you, Michael. Cheers. Thank you for having me.